I want to welcome everybody to another edition of the Asset Back Podcast. This is your host, Andres Sandate. I am joined today by Cesar Bello of Corbin Capital Partners. Cesar, welcome to the Asset Back Podcast.
Thank you. Thanks for having me.
I can see you have a lot going on there, so I'm really glad that you could take an hour and join me live from the trading floor, from the investment floor. Thanks for joining me. We're going to talk about litigation finance today, and you put out a really great white paper that I'm going to post to the comments and the recording of the show for folks. But that really inspired me to reach out. We hadn't met, and I just thought the paper was terrific and really gave an overview, but it was a great primer, but also went into some good depth on the litigation finance space, which is booming and is interesting and is very much something I want to dive into. Before I do that, though, I'd love to learn more about you and your background. You're at Corbin Capital Partners. You guys run, $8 or $9 billion dollars, and a lot of that's in credit strategies. So tell us a little bit about your background and how you kind of arrived to where you're at.
Yeah, sure. So first of all, thanks for the comments on the white paper. We're trying to strike the right balance between not making it 20 pages and super deep, but
Yeah,
having enough in there that had some meat. So appreciate that.
it was great. Yeah.
So my background, I'm an attorney by training. I've been an investor for the last 5 or 6 years, but I practiced law for about 15 years. I was at big law firms, Skadden, Arps, Kramer Levin. And then I went in-house, ultimately was the deputy general counsel here at Corbin, deal counsel. So on our private transactions, I really was involved in all of them, structuring them, negotiating them, uh, working them out when there were issues, litigating and managing litigations when that happened. I have a really good understanding of how law firms work, I would say, and managing those processes. Uh, but about 6 years ago, I was tapped by our CIO to focus on this space. It was sort of an emerging space that was interesting for a few reasons, right? So it's uncorrelated, which is super valuable to find return streams that are not tethered to the market. I would say in a world right now that feels a little bit like a powder keg geopolitically, and when things go bad, most correlations tend to go to one. To have something that is a true diversifier that's not going to move up and down with everything else is a valuable in folks' portfolio. So that attracted us to it. We kind of approach it with a credit lens. That's sort of our DNA. So we're always thinking about off ramps and downside protection and trying to mitigate the binary risks that's often inherent in these situations, right? We're not trying to take a lot of single case risk where we're swinging for the fences or making a zero, right? That's not our approach. And there's a lot of different ways to play this space, frankly. Each, uh, you know, subsector within the space has a very different risk profile. I've transitioned. I've been investing in the space now for about 6 years. We've had a lot of good results and interesting experiences and learnings, which I tried to somewhat share in the white paper. We have to keep some secrets to ourselves,
Sure.
but yeah, I mean that's kind of what brings us here today.
Yeah, no, that's terrific. Well, I have to give you kudos. I mean, um, with all due respect to my lawyer friends, you don't speak like a lawyer anymore. You sound like an investor. You sound like you've been pitching to investors and talking portfolio and talking underwriting, which obviously you can't do this without being able to do that. But I would imagine that legal background and at the organizations and firms you mentioned was terrific training ground. Not to mention being deputy GC at a firm the size of Corbin probably gave you a lot of really good experience, to say the least,
Yeah,
to be able to lean into this offering and strategy.
it's a good observation because the background is really good for the substance of the work, but it's not so great, when you're trying to sell something or pitch it or talk about it. You need to kind of shed all of that,
Yes,
and
you do.
be a little bit more normal.
A little bit more economical or commercial.
Yeah,
And you have to
uh,
be kind of tight and succinct in how you present, right? Like I said, my good lawyer friends can explain points in such fine granular detail, but the investment community, puts a premium on present the idea, keep it simple, but make it so plainly obvious that I would want to invest.
yeah,
And so I took some notes as I was preparing for our conversation today from your white paper. So I'm just going to read, and I'd love to get your reaction. So litigation finance, or LitFin, as you call it, is provision of third party capital to help finance law firms or plaintiffs pursuing legal claims in exchange for a portion of proceeds received. So that's kind of the opening of your paper. It's an emerging asset class. And what really got me excited about having this conversation is I've spent a long time in alternative investing, and you say things in here about the asset class that I think a lot of investors are looking for when they think about non traditional diversifying alternative strategies, particularly in the private markets. Inefficiency, fragmentation, undercapitalized, misunderstood. That all sounds like a lot of why would you want to go into that area? But tell us about the setup of litigation finance. Why is there a need for more capital in the space, and you're provisioning capital to plaintiffs and law firms? But let's understand the backdrop first. There's some clear advantages to being in it, but as an investor, help us understand kind of why it is so attractive.
yeah. Well, look, I think there's two sides of the coin always, right? There's risk and reward. So it's attractive, but it's not a free lunch, right? There's
Yeah,
a lot of I don't know if peril is the right word, but you really have to know what you're doing and who you're dealing with, and who the parties are, and think about things a little bit more holistically, not just in terms of the case, but who the attorney is. Even if you win the case, can you collect, right? So, um, a lot of uh, a lot of these factors, any one of them can kind of throw you off and prevent you from having a successful outcome. So, um, some of these things are things we've learned over the years. Some of them are sort of more inherent and apparent. But I mean, what's a good place to start? Should what do you?
I think a good place to start would be, there are different types of cases. You have consumer, which is a more
Yeah,
regulated area, which I know is where Corbin does not tend to play. And then there's
yeah.
the more commercial side, which is also sort of synonymous with institutional. And it tends to be less regulation there per se. So let's talk about where Corbin focuses on the commercial side. And that can be everything from mass torts to intellectual property
Okay.
to that. So let's just the opportunity in litigation finance is consumer and commercial. Within that, there's the commercial side. Let's talk about what that represents.
Yeah, yeah. And I guess before we even get there, I would say, why um why does the opportunity
Exist.
exist?
Yeah.
If you think about it at a basic level, you have an asset that is pretty hard to value, right? It's not like your collateral is a piece of property, a home, a building that you can easily assess and take, if somebody doesn't return, pay back your loan, right? So that by definition knocks out a lot of the traditional capital providers, right? Therefore, it's underbanked, it's a little bit misunderstood, and that just limits the amounts of folks who can get involved in a more esoteric asset class, right? And within LitFin, you're talking about to segue to the types of things we do, even within the commercial space, you have business disputes, right? Commercial, traditional partnership disputes, what have you. You could have intellectual property disputes, antitrust, stuff that's in bankruptcy, international arbitration. So every one of those is very different and has a very different duration profile, return profile. Um, sort of market in terms of how deals get done within that space, right? There's now a big push by insurance companies to come into the space and effectively, provide a lot of downside protection, if the next event in the case doesn't go as you predicted, right? So that is allowing people like us to do more and to scale more because I can put more money to work if I'm taking a view on a case that is, not as binary because if I'm wrong, I still have an insurance policy to go tap, right? So constantly trying to find off ramps and ways to mitigate my risk and move away from again the binary risk, the flip of a coin risk, which
Yeah.
which you often see in this space.
Yeah. So, and I led you down that path. So I want to back up a second and I want to talk a little bit more about the why. So why the litigation finance exists. So, we in the US, let's talk about the US. I know there can be international opportunities, but let's talk about the US. This is a more meaningful percentage of GDP in terms of cases and settlements, et cetera, than people realize. I think your paper put the stat out that it's over 2%, 2 to 2.5% of GDP. Is potentially a result of cases, settlements, etc. So it's a big market, $1 trillion. I think your paper estimates.
Internationally,
Um,
yeah.
yeah. So, but in terms of the why, the perception is big companies may have the financial resources, right? Because in litigation and in the legal world, like the deeper pocket typically has more resources, has
Yeah.
more of an advantage. But your paper outlines there's a lot of benefits for why uh, institutions and organizations that have financial resources might even consider litigation finance. The same with big law firms. So, can you kind of talk about the why the capital is needed? I know timing and the time frame for these cases is a big deal, but maybe you could give us a couple of more.
Yeah.
Uh,
So there's a spectrum to that answer, right? So on
yeah,
one end of the spectrum, you have just folks who have a good case but can't afford to fight the other side because the other side may be a big corporation with unlimited resources, right? So that's your typical David and Goliath
yeah,
situation where, frankly, in our legal system, it's not necessarily merit based. It's a lot of it has to do with who has more money and resources in terms of who's going to win, right? So to the extent, you know, you can even the playing field a little bit. And by the way, we're doing this. It has to be obviously things that we are highly convicted in and believe in because this is typically non-recourse financing. So, um, you know, we're not going to put our money and our investors' money into things that we don't have a high conviction in because we could lose our money, right? So that speaks to us backing and funding compensable cases that we think we have a good chance to win. And back to what I initially said, the initial demand is for folks who don't have the money and can't compete, right? And it could be in a mass tort setting, it could be sort of a collective action problem, right? So let's pick one. So one case we funded a law firm involved in representing individual claimants against the Sackler family in their bankruptcy as a result of the opioid crisis, right? If you are a victim or your son's a victim, um, you individually don't have the resources to take on the Sackler family in a bankruptcy. That'll never happen. So there's a collective action problem. But with our legal system, if you can actually create enough of a group and create enough incentives for a law firm to be willing to work on contingency, so they're also pretty aligned because if they don't win, they're not going to get anything. With financing from folks like us to sort of pay for experts, uh, pay for the law firms, to grow their team, to manage a caseload, to find the claimants. Then you can see kind of you're starting to even the playing field a little bit, and can actually challenge and take some of these uh, big, large corporates on. But so that's one end of it, and that's a little bit, I would say more obvious, right? But even for corporations that have resources, oftentimes this is looked at as sort of a, if you have a case that's worthwhile and it's on your sheet, it's often sort of a, think of it as a back office function. It's like the company has it makes widgets and it's focused on making widgets, and that's how it's valued, and that's what drives its P&L. And the earnings reports are based on making those widgets. It's not based on, well, we actually have this other asset over here that can be worth a lot of money, but we need to put $10 million into funding this case to monetize it, right? They're not in that business, right? So, and in fact, I would argue that they're often penalized for
Yeah.
funding those
Yeah.
themselves
Yeah.
because, any credit that they get if they actually win a case is sort of viewed as a one-time event that's not
Hmm.
going to really get them uh, a multiple, which is how they're normally valued. It's going to be sort of discarded from a valuation perspective. Uh, so to them, if they can find somebody to finance that case and they don't have to spend their budget on the one-off legal event that they don't get credit for in the markets from a valuation perspective, uh, then that's great, right? They're sort of largely off risk. And so long as they're willing to share some of the upside with the people investing, it can be a win-win for everyone.
Yeah. And from the standpoint of, transitioning to how, you know, investors can start to think about exposure to the space, you all talk about in your white paper, there's a couple of things that make it a pretty compelling area in a diversified portfolio. One of them is, you mentioned this earlier, Caesar, the uncorrelated nature of the asset class, and then within the portfolio, somewhat of the uncorrelated nature of the individual cases, to the extent that you're partnering with the right asset manager. So that's one thing I'd love for you to talk about. How do you all think about that at Corbin in terms of correlation and diversification? Because I would assume when you're building, we can't
Yeah,
talk about your fund, but when you're building a portfolio, you're thinking about diversification.
yeah. So clearly, we're investing in idiosyncratic legal outcomes. It's got nothing to do with the stock market. So there's broad uncorrelation that's attractive to the asset class. But within the portfolio, if you're doing it right, um, the positions themselves should not rise and fall together, right? The earthquake in Japan has nothing to do with the Johnson and Johnson, talc mass tort, right? So um, the covariance of the portfolio should be negative or close to it if you're doing it right. I mean, just got to be mindful not to put the same type of legal risk on, but that's pretty easy to manage in terms of our pipeline and what we're seeing. But what you get then is something that's truly powerful because it's not just uncorrelated to the broader markets, but it's truly diversified within itself, within the portfolio.
Yeah, yeah. And then the second thing, and you brought this up earlier, when you think about the commercial side and more that institutional side where you all focus, you have a spectrum of risk and return opportunities. And so, if you want to go further out on the risk spectrum and reward spectrum, you have things that are more dequity or even equity like, in terms of like your single case type outcomes, but all the way on the other spectrum in terms of, call it lower risk but lower return. There has been a settlement, but the settlement is not final, i.e., there hasn't been distribution of any capital or any dollars, and then there's a number of things in between. So as you're thinking about risk and return, how does your team, and how do you go about sort of thinking about that continuum and sourcing and originating cases and opportunities?
Yeah. So it's a really good point because I think I tried to touch on this before, but just to expound on it. So within litigation finance, there's probably 6 or 7 different subsectors that are all very different from each other. So on the safest end of the spectrum is the post-settlement stuff, right? So that's the case is settled, the money's coming. It's effectively a receivables lending exercise, akin to factoring to some extent. So what are the dynamics at play there that make it interesting for everybody involved? So could be a law firm has been working on a case for 4 years. They're working on contingency. They haven't gotten a dollar yet. They've settled the case, but it's still going to take a year or two to get cash. And you can imagine why, right? So let's go back to the opioids example. So, okay, you have a, a wide disparity of victims. You could have some folks who died, some folks who didn't die, but have serious complications. Some folks who will need sort of medical oversight forever, but maybe their injuries were less mild. So there has to be a process of gridding all of this and getting the proper, medical documentation to back it up. And as you're going through this for, tens of thousands of people, it's going to take time. But if you zoom out, you have an asset that is close to money good as you can get. So if you're willing to lend at, let's say, a 50% LTV to that, settlement amount, that feels like pretty good risk. You're getting paid, low to mid teens for that. And it's shorter duration, right? So if you want shorter duration credit like risk at those levels, that's an interesting sort of subsection of the space to play. And you can keep going up the risk curve. Let's just skip all the way to the end to make the juxtapose the two examples and come up with the most dramatic one. So the riskiest thing you can do is invest in a single case at the very beginning, right? So, we typically don't do a ton of that, but, we have a pretty wide sourcing funnel. So we will see stuff at times that it makes sense to structure and swing a little harder on. That way we would size them much smaller, right? Because you're taking more risk. But think about that as, okay, we really like this case, but we haven't even gotten past summary judgment motion yet. So you have to analyze, okay, what's the budget of the case going to be if it goes all the way through? It's going to be $5 million, right? So how do you start to tackle that and create a structure that works from an investment perspective that aligns incentives there? So you could imagine saying, hey, we'll commit to $5 million, but really we're only going to fund $250,000 at this stage. Once you get past summary judgment motion and this thing, looks like it has more legs and de-risk, and then you will need more budget to go to trial, et cetera, then we'll make more money available. And then, set another milestone and do the same there, right? So the idea is, yes, those are risky propositions where if you lose the case, you're going to get a zero. But if you scale into them methodically, you're only really growing the position as the thing is working, as you're having more observation points. So even there, right, with the right type of profile, the structuring comes into effect. And in theory, you're creating a portfolio of these, right? So if you have 5 and 2 ultimately don't work, and 3 do, the ones that do, you're underwriting to make a 2, 3, 4, 5x. That's more of a venture capital kind of return profile model that on a blended basis should really work, especially if you're losers. You're kind of not fully funding, you're losing earlier, they're smaller, right? And the thing that's important to keep in mind, which is often not top of mind for folks, is you don't need, unlike venture capital, a capital markets solution here. You don't need another company to buy you out. You don't need to IPO. These are, idiosyncratic legal outcomes that a judge is going to rule, and there's going to be a self, liquidating outcome, independent of whether the stock market's crashing or not, right? So then it's more of an exercise about, okay, who's your counterparty? Can they pay? Hopefully you've done that work ahead of time. But all of that, I think, is very different than most asset classes. And, there should be a place in folks' portfolio for taking that type of risk.
Yeah, for sure. I keep thinking back to 2 words that I think are early on in your paper in describing this industry and this ecosystem. And I could have read another paper, but is inside baseball synonymous with what you're describing in terms of just knowing the attorneys, knowing who the players are, knowing the cases. Am I imagining something, or is that a term
No,
that's used
that's
in
a
your,
big that's I use
yeah.
that term often, so you probably it probably isn't my paper.
Yeah, I think it
But
is.
it really matters, right? Because now let's go back down to, in the mass tort space. But let's say a case that hasn't settled, that is sort of midway, right? So it's riskier, and there's various stages um, to the life cycle of a mass tort, right? Let's say you get an MDL certified, so it becomes now a mass action, a multi-district litigation, and you have to go get through a Daubert process where it's effectively a battle of the experts to see if there is uh, uh, a scientific reason that's valid to allow the case to potentially move forward, right? So um, all all, at every step of the way in the ecosystem, you have a ton of different players, right?
Yeah.
So um, what do you need? First, you need to build a book. You need to find claimants. So let's pick a case like Camp Lejeune. For those of you who aren't familiar, this is a Marine base camp where for decades there was a water contamination issue, uh, and a bunch of folks on the base, veterans and their families, got cancer, leukemia, had other complications, pretty bad stuff. Um, so the history of it is, it sort of was not talked about for a long time. Eventually, the government admitted that there was an issue, but they said, hey, the statute of limitation had lapsed. So sorry, you can't do anything about it. Well, the Congress, actually in a bipartisan manner, which is quite rare, passed legislation to create a window for people who were harmed by this to bring their cases. Window's about to end in August this year, actually, but it's been open for a couple of years. So there's a big rush to sort of advertise and find these folks, to get the claimants together to bring suit. So there are, to the inside baseball question, there are folks in this space who are more focused on the marketing and the aggregating of claimants that are
Yeah.
lawyers. There's also other lawyers along the life cycle here who are focused more on actually trying the case, and they're in leadership, and they're the ones in the steering committees, and they're the ones doing the real litigating. And at any point, and there's stuff in between, sort of the handling firms that are maybe sit somewhere in between, and they kind of co-counsel with folks. Um, and the lines start to get a little blurred, but each of these folks, their law firm may be at a particular point in time when maybe they don't have a lot of runway in terms of their OPEX, or maybe they do. Maybe they're a big brand name and there's no issues about them ever running out of money, and they can continue to bring cases. And the latter are the folks that scare the big corporate defendants, right? Because if you don't settle with them, they're just going to keep coming at you, and
Hmm.
they may tag you for 100 million here, 100 million there, a couple billion there, which has happened. But there's a lot of folks, again, in the ecosystem that are kind of just drafting, not able to drive an outcome themselves. So it comes back to this really knowing who the players are,
Yeah.
and there's a lot of dispersion in terms of ultimate settlement outcomes, uh, not having anything to do with the case, but just on who the law firms are, right? So you kind of need to be in the space and have a sense for that as well.
Yeah. Well, you're just reiterating a lot of the things that you know uh, I think make alternative investing. It's really important, right? Who the jockey is, like who's the jockey, who's training the horse, right? The horse matters, but at the end of the day, this is an asset class, I think, that just really does sort of is synonymous with the inefficiency, the information, the lack of liquidity, and so knowing you are in good hands, right, and with experienced hands, um, is so critical. I want to shift a little bit and talk a little bit about regulation and innovation in the space. It is emerging, and it is an international uh, uh, asset class when you include what's going on in Europe in particular. So talk about innovation and regulation for a second, Caesar, because there's been some new laws I know in the state of Arizona that's had a pretty meaningful impact here of late for folks that are maybe less aware of what has happened. Can you kind of give a summary?
Yeah, that's something that's always evolving and changing, and it's, varies per jurisdiction. So there's a lot of time we can spend talking about that. But what you're speaking to in particular is a more recent development in Arizona, where for the first time, they've allowed non-lawyers to take equity interest in law firms. So historically, there's been concerns about how law firms are financed, and some of those I think are sort of archaic and a little bit, don't make sense in a modern world. But the concerns were, hey, we don't want people who are non-lawyers being able to influence the case, and this really is a profession that is special and should be, you're just creating, barriers to entry. Um, and the flip side of that is, hey, a law firm is a business like any other business. Why should they not be able to finance themselves as they see fit to grow their business? Right? That's fairly anti-capitalist. But Arizona, being a little more progressive, and there's been a couple of states that are follow suit, has said, we need to register and we need to kind of verify who this is. But here, you can actually take financing from non-lawyers for your law firm, and that's created an ability to sort of partner with law firms in a different way and express maybe the same risk in a much better way to capture more upside, to better align incentives, I think, with the law firms, because otherwise it's just a very sort of one-dimensional lender borrower relationship. And to the extent you can sort of have more of an equity relationship or a different type of partnership, um, it just creates optionality for
Yeah,
folks, right, to sort of
yeah,
design what they think works best for them.
yeah. Makes sense. There was a point in time where I said I want to go to law school, and the one of the things that I was attracted to it is the best lawyers are great writers, and credit to you because the terminology in the paper, and again, I'm going to post this for folks, is about expressing risk. When you say risk and investing, some people may say, "Well, I don't want risk," but we all know you can't make money unless you're willing to take risk, and the way that you outline expressing risk throughout the paper just makes a complete ton of sense. So credit to you. But I want to talk about two other things before we get into some of the challenges of the space. Because every asset class, there's no free lunch, like you said. The first is I want to talk about insurance companies, and insurance has moved into the litigation finance area. And I want to ask how is that development at Corbin? It sounds like they're looked at similar to funders as a sort of adjacent party to the conversation and to these opportunities. Can you talk more about that point that you're making?
Yeah, so it's a tool in the toolkit, right? So let's pick an example. This is a live case that we're working through right now. So uh, there was a uh, commercial lease where the tenant defaulted and there was a parent guarantee. So, the big parent company is supposed to pay the difference between, for the period of time where they stopped paying their lease. This went to trial for a few years, and ultimately there was a judgment, say $14 million judgment for the landlord. Um, okay, that's great. So you've come very far, but not quite to the end yet because it's still subject to appellate risk, right? So maybe we have a couple more years where this could drag on, and we don't think it'll be overturned, but it could. So um, when folks have that judgment, that's effectively an asset, right? So if they're smart, a lot of them will try to monetize it because there's still some risk on the back end. So they'll say, hey, will you lend me some money? I've already gotten the case 90% there. I'm going to win. Will you give me some money against this? And when I get the money in a couple of years after the appeals, I'll pay you something back. So that it's claim monetization. You want to monetize your claim. well, if I'm taking binary risk, and I could lose it all, I'm going to price that very differently, and I'm going to size it very differently. I might say, hey, I'll lend you $2 million on this, but I want to make back, 4.5 or 5.
Yeah.
Uh, and I can't take much more risk in this because look, I don't, my risk tolerance is such that I don't want to lose more than $2 million in this trade, and I really need to take a big chunk of the upside for the risk. But now let's say there's an insurance company involved, and the insurance company would say, well, I'll give you a policy to insure the entire $14 million. You have to pay me, 13% of the policy up front.
Right. Yeah.
So, okay. So that allows us then, if the claimant gets that policy, they can come to us and say, hey, not only do I have a judgment, but I have an insurance policy on this.
In hand.
How much money? Yeah, how much money can I get out of this now, and what will you charge me for it? And I say, well, that's a very different risk profile.
Yeah.
So I will actually lend you $8 million and charge you only, 14% interest. And if the appellate decision goes against me, well, then I can look to the insurance policy, right? And that's much better risk reward, a better Sharpe ratio in our jargon,
Yeah.
than taking the more binary, more lucrative on an absolute basis bet. So the insurance companies have come into the space in a big way, and it's allowed us to be a lot more creative with the structuring, and allowed us to do a lot more size than we
Right.
otherwise would.
Well, and I think you said it at the very beginning. It's another lever. It's another tool. So uh, that's great. Let's talk about AI and LLMs, large language models. They have become synonymous with innovation, and I just am curious. We don't have to spend a lot of time on it, but I'm curious how is AI and LLMs going to impact the work that goes into just what is synonymous with the legal field, which is just documentation.
Yeah, I would actually take it a step back and just say digitization generally and technology has really shifted the landscape on a lot of this stuff because, back to that Camp Lejeune case, um, 20 years ago, it was, 1-800 Camp Lejeune, and, you had to put out TV ads and radio ads and take a physical phone call. And that's how you found the folks that were harmed and tried to get them uh, some justice. Now, um, a lot of the outreach is digital, you know,
Hmm.
uh, uh, so the digitization of everything has created an opportunity to sort of reach more people faster and cheaper, and it's totally, transformed the economics. Um, and so that's one aspect of it, right? So the cases are getting bigger now. Um, the the potential damages are bigger. It's more, it's simpler and more complicated in some ways to sort of get to people and sort of build a book. This is more particular to mass torts, but AI in general. I mean, there's always been folks, who have had proprietary technology to find cases, sort of scraping dockets, right? So they have some algorithms that'll look through the Illinois state court docket for certain keywords that they think are important, or phrases, or to sort of cull that docket and figure out, okay, these 20 cases are interesting, and these we're going to actually download and have humans read because we think there's an ability to maybe provide some financing here. This kind of fits our box. So all of that is getting more and more accelerated as these LLMs get more powerful. And I'm sure some folks are going to do it better than other. I don't have the axe or sort of crystal ball on kind of where that's going to end up. I think you have to be a little wary because everybody effectively oversells
Yeah.
kind of their AI capabilities today and what this is actually doing. Ultimately, there's a big human element to this of judgment and decision making, and you can't really outsource that, at least not yet. But certainly another tool that can help you, mine the playing field faster and better, and
Yeah.
better curate things. And who knows where it's going to go, right?
Yeah, I mean, I heard another credit manager describe their use of AI and machine learning, and it effectively allows them to do a lot bigger filtering of a broader universe, and then for the human that's going to be touching it, because there is a human element that's absolutely involved here. But at this particular credit firm, similarly, it just, instead of having 300 opportunities, they can look at what are potentially like the 15 most promising ones. So it's a signal, effectively.
So ultimately that means it increases the efficiency of,
There you go.
that employee, and you get more operational leverage out of each employee because you have this other toolkit you can
That's
use,
right.
right?
Yeah, and you all are as a firm stepping way back. I mean, 8 or 9 billion dollars, $9 billion, I think you said, and what, 50 employees? I mean,
Yeah,
so talking about
55 or so.
operational leverage. We wouldn't be talking fairly about any asset or investment if we didn't talk about some of the challenges. So as we finish up here, I want to spend maybe 5 minutes talking about some of the challenges that you've encountered at Corbin, and that just the space in general presents. One of the most obvious ones is just the time involved, the duration. So when you think about it as a credit investor or through a credit lens, obviously time is a risk factor, duration. So I don't want to pigeonhole you, but let's just talk about some of the bigger challenges in the space.
Yeah, so duration is the biggest one. No qualms about it. Uh, it's a challenge for a bunch of reasons. It's largely out of your control. Look, generally, when there's illiquidity, you want to be getting paid a premium, right? This is an illiquid asset class. But the way we try to tackle it is we try to be intentional about our entry point and not come in early, come in later in the process. So think seventh, eighth inning, think insurance wrap, think diversified portfolio, things that make it more of a credit-like risk profile. Not that we're necessarily just making loans, we're finding different ways to invest, but we want to do it when we're closer to monetizing. And sometimes you
Yeah,
think you're in the seventh or eighth inning and you're actually in the fourth, and that's unfortunate. You got to deal with it. But if you structure your deals correctly, you have some IR maintenance, and you're getting paid to wait, right? So you got to build all these things in ex ante. So even if you're in a place where you don't want to be, you're at least getting compensated for it. But duration is a problem. It was a big problem during COVID when things kind of shut down and extended. It can have a big impact on your IRR. And frankly, a lot of the defense delay tactics here are to extend and drag it out,
yep,
to make it more painful for these law firms who are working for free until there's an outcome, right? So
yeah, yeah. Well, I think you say something that I learned as an underwriter way back in many moons ago, when I was an investment banker, and we used to say, the intention, the willingness, and the ability and the willingness to pay. You call it, a reasonable path to settlement, collectability, and an ability to pay. But you sort of put all of that under collectability. And early on in the paper, you talk about the monetization aspect of these cases. So, um, lastly, I think that kind of gets us to sort of your approach, and you've kind of alluded to this throughout. So, I want to give you a chance to sort of talk about the firm and the culture and your all's approach. You've described it as having, a credit like approach and having various levers to pull and different off ramps. Are there other aspects that you try in the insurance? Are there other aspects that you try to sort of build in, or you've learned to build in, beyond the inside baseball and knowing which cases and which players? What other things have you guys learned, that make it sort of unique to you without giving any special secrets away?
yeah, I mean, I think one of the most important things we haven't touched on is like the sourcing, your ability to find these cases, right?
Yeah.
Because it's almost everything, right? You need to be seeing a lot to do the good ones. So we have a partnership model where we have a bunch of sourcing partners, effectively, um, dedicated in their particular, let's call it fishing hole, right? So some guys are just doing IP, some guys are just doing mass torts, some guys are a little more broad. But generally, these are folks who we think are best in class in their particular vertical, and we are constantly working with them to look at interesting deals, work on them together. Maybe they need some completion capital. Maybe they want our sort of not just capital, but underwriting and structuring expertise. So um, the idea is to have as cast a wide a net as possible across partners and geographies with folks that we know and we have a shorthand with and we've got reps with that we trust to really see quality stuff across the various pillars, that we talked about before within commercial
Yeah,
litigation
because
finance.
there's so many themes, there's so many risk profiles, there's so many variables, and there are a lot of different segments, and each of them could merit its own episode here on the show. Um, just in wrapping up, litigation finance or litfin is, as you describe in your concluding remarks in the white paper, is an esoteric and evolving asset class. As you think about it in terms of the conversation with the investor community, um, what are the best ways for folks to kind of learn about the funding side? You're one of the funding side, but what are some good ways for folks to continue their education around this esoteric and kind of emerging asset class?
Um, you can
Is it
email
just
me.
called
We can
is it just
chat a
called
little bit.
Caesar?
um,
That was going to be
I'm
my
happy to
last
chat.
question. How do they get in touch with you?
I mean, you can just email me or
Yeah.
you can hit me up on LinkedIn, but cbello at corbincapital.com. But honestly, there's a lot of stuff out there. There's good publications, just focused on the space and journals. Um, but everybody takes a different approach to this space, and some people are hyper specialized, some not. Some people like to play for the 5x and are happy to hang out for 8 years. Some are like us, trying to do things much shorter and much more kind of credit based. So it's a hard question to answer because it's still sort of an underground asset class, if you will,
Yeah,
right?
it is. It is.
So
But having said that, I think we're gonna just run with the inside baseball analogy, because before we hit record, the one person I asked if you knew in the space that I knew pretty well and used to work with, you said, "Oh, I know him." So
yeah,
that confirmed I had to each of these episodes has a theme, and this one was it was gonna develop a theme because we said we were just gonna riff, right? And none of the
yeah.
questions I had were prepared in advance, and I think you did an outstanding job. So we'll go with the inside baseball. Um, Last comment is yours. You mentioned this a minute ago, Cesar. How do people learn more about your firm, and maybe more importantly, how do they get in touch?
Yep. So, website corbincapital.com. You can email me directly, cbello at corbincapital.com. And whether you want to talk about the space in generally, you have a good deal. I live and breathe this stuff, so I'm happy to chat with anyone on it.
I know you do. Well, I want to thank you for joining me on the Asset Back podcast today to talk litigation finance. I thought it was very interesting. There's clearly going to be a lot of developments. We'll be watching all the continued success at your firm, and I look forward to having you back on a future episode. So, Cesar Bello, thank you for joining me today on the Asset Back podcast.
Awesome. Thanks for having me, Andres. Take
Okay,
care.
all the best. Take care.
Bye.